So if you are a beginning trader who's having any sort of confusion about how to size up, how to size into trades, when to size up, if it's even something you should do and how you should do it, I'm going to try to make this the best place to solve those questions and problems for you. My name is Kyle Williams. Welcome to the Clover YouTube Trading channel, and let's just jump right into it. So, there's two schools of thought when I think most people hear about sizing up. It's either A, or just sizing in general. It's sizing the same across the board, right? Doesn't matter if you see a breakout, doesn't mean if you see a short setup, a breakdown, take the same size. Or there is the other train of thought where it is, hey, you need to be exponentially bet sizing. So if you see a setup that you're very, very good at, and that setup is like all the stars align and everything's so good it can't get any better, you need to be risking way more in that setup than some, lower grade, less ideal setup that just isn't that very good, okay? I would agree with both. I am in both schools of thought. What matters is where you are individually in your trading career. Because if you are a beginner, and by beginner, I mean someone who is probably not profitable yet, and someone who maybe is profitable, but it hasn't put a string in of multiple profitable years back to back yet consistently, I would say you're in that boat. And when you're in that boat, I would not think about exponentially bet sizing one bit, right? I love what Dom says, and if you've been in the Clover room, you've heard Dom say this all the time, is that you need to take the approach that you don't know what you're doing. Even if you think you know what you're doing, right? There are so many scenarios and trades and just experience as a trader that you have to gather over hundreds of thousands of hours, if not years of practice. You kind of have to know and assume that you don't know what you're doing.
Ever dreamed of trading like one of the Clovers? Well, it all starts with choosing the right broker. Clover Trading and Cobra have teamed up to supercharge your trading experience. By clicking below, you'll unlock the power of Cobra Prime. We're talking top-tier trading tools, saving you hundreds of dollars. Get ahead with real-time scanners, cutting-edge news, 30 days of commission-free trading, 30 days of free DAS software, 60 days free of Ask Edgar, and so much more. Imagine all that, plus superior short inventory, personalized support, and interest on your idle funds. But it doesn't stop there. Cobra offers competitive pricing on locates and commissions that fit your trading style, with the ability to trade stocks, futures, options, and other products. If you're under the pattern day trading rule, Cobra has a unique solution for you. Venom, a platform designed for traders with smaller accounts to go long or short on small and mid-cap stocks. Ready to elevate your trading game and save big? Click the link below to access exclusive deals only available through Clover Trading and Cobra.
Even myself, being 9 years in, I am still learning things. So if you're only 1 year in, 2 years in, 3 years in, you haven't even made your first $10,000, $50,000, $100,000 in the market, just think about that for a second. If I'm still learning, and I'm, okay with myself doing exponential bet sizing, but you're only a fraction of the time or hours in than I am, it's safe to say you don't know what you don't know. And so taking the same level of risk across every single trade, I think one, will keep you alive, but two, let you gain that experience without risking a ruin of your account, right? So if we take my Excel sheet here, this is what I'm doing right now. Right. And we made a video on this topic back in December of 2024 last year. So go watch that video. I describe why I'm doing what I'm doing with my exponential bet sizing, which we'll get to a little bit at the end of this video. But I want to go over if you're a beginning trader. Let's say you've got a starting account value of $10,000. Okay. And let's make it so it's a dollar amount, right? You might be thinking, well, Kyle, how much do I know how to risk? In general, I like to follow the 1% rule, right? I like to follow 1%. Okay. Which means this would be 10,000 times 0.01, right? So $100. Why would you do that? And why did I do that when I first started? Because when you're a beginning trader, especially if you're an unprofitable trader, you're going to go through some of the worst drawdowns or losing streaks you will ever in your career. Why? Because you're going to be losing the most, if not ever, when you're beginning. And because I know for me, I lost like 15 to 14 losses in a row. Like you couldn't pay me money to find and buy a win. Like I just couldn't. And so if I was risking 5%, right? If I was risking something like $500 a trade, well, after 14 losses, let's just hypothetically play this out, times 14, right? $7,000. I'd be down 70% of my account in just 15 or 14 losses. That's crazy. I promise you, you won't survive your learning curve if that's the case. And $500 is conservative. Some people lose $1,000 per trade. You lose 14 times in a row, you're done. That account's blown up. You've lost $14,000 and you only have a $10,000 account. You're donezo. So risking $100 allows you to stay in the game. I could lose 99 times, right? And still have, obviously my account would be practically blown up, but I could lose 99 times and still have $100 in my account technically. Now, obviously that's not realistic. We don't want that to happen, but you notice how many times you have to lose. You have to have a 99 losing streak. Most people don't lose 99 times in a row. And if you do, I mean, gosh, you have probably a record. Like, put it this way, try to flip it on its head. Try to lose 99 times in a row. You probably couldn't. You're probably going to stumble upon a win, even if you suck, right? So that's why we do that. Okay, because it's going to keep you to stay in the game. It's going to help you survive that learning curve and eventually come out of it and start growing the account. Now, when you start growing the account, that's when you can start to think about sizing up. But if you grow the account and stick to the 1% rule, that's going to happen automatically. So let's say I find some level of profitability and my account grows to 11K. Okay. Well, naturally, you're going to start risking $110 per trade. Let's say that keeps working. Your consistency grows, you start gaining more trades, and your accounts start growing, and in 3 months' time, you're now at a 15K account. Well, now you're going to be risking $150 a trade, right? So that is going to increase if you follow this 1% rule. You don't have to. It's not a law by any means, but if you do that, your risk will increase as your account increases. But where it gets fancy is, well, do I adjust my risk level for how great of a setup I have in front of me? That shouldn't even be something most traders even think about until they have well over 6 figures in bankroll, or they've been profitable for multiple years, and they arguably have thousands of hours of experience of even being able to tell what trade is ideal and what's not. Right? Even when you first get started trading, you don't know what makes an A+ from a B or an A from a C. I even had a student make a great point in our chat room the other day. He actually tried to start making B grade trades into A's because the market environment wasn't that great for him. So he was just justifying his head of like, oh, well, this is the best setup I'm being given right now in this market environment. So let's just take A grade size instead of B grade size. When objectively, the setup wasn't that good to get an A grade, but he gave it an A grade because that's all he had in the market. Think about that. Think about that level of psychology of just all the different angles a beginning trader can fooling themselves and making justifications of why they would size up before they even have all of the groundwork, all of the experience, all of the bankroll to be able to use to their advantage. And instead, as a beginning trader, they don't have those things, so it's actually to their disadvantage. Like, that's how you blow up an account. Just straight up. You could be following this rule all day long. You could have done what I just said and grown your $10,000 account into $15,000. But the moment you try to get fancy with it and say, okay, well now I think I know what I know, even though you don't know what you don't know, I'm going to start risking 3% on what I think is a next best setup. And so instead of 150, you're risking 450. Right? You're risking $450, and all of a sudden you don't have the discipline or the experience or the know-how to fluctuate those risk levels, or let alone just the familiarity with it. And all of a sudden, again, you take, 10 losers in a row, and that's going to be what, $4,500? You're going to give back a third of your account just like that. Right? Versus if you kept it at 150 and you lost 10 times in a row, it would only have been 1,500. You're only going to be down 10%. It's a big difference. I know it doesn't sound like a lot, but from a trader who's just trying to get a big grip and a great footing underneath them, I think this is crucial. Okay? So again, I know you don't want to hear that you can't exponential bet size until a certain time. Again, I'm not the stock market police. You can do whatever you want. I'm just, as an educator, trying to give out the best information that I know worked for me and why I even stayed alive to get to the point of where I'm at. It wasn't doing this. Right? And that's the kind of point I want to see. It's like, use like a sports analogy. Like, you see the NBA players being at the NBA and you're like, oh, wow, look all the moves they're making. Look all the dunks they're making. They're so good. I want to do that. And it's my first year playing basketball. You only see where they are now, not where they started. This is where I'm now 9 years in, right? What you don't see is where I was year one. This is where I was year one. This is where I was year two. Year one, I was still losing. Year one, I was letting my first 6K E-Trade account get dwindled down to like 2,300 and change. Like, it was down that low very quickly. But what kept me alive from not blowing that account up is that I was actually risking the 1%, and I kept it the 1%. So at first it was $60, right? But by the time it was 2,300, I was barely losing $20 a trade. So think about that. I know we talked about the 1% rule being 99 trades of 10,000, but as your account decreases, technically so does the 1%. And so that's really going to keep you in the game. You want almost not a foolproof, but you want the absolute best chances of succeeding a learning curve. It's this right here. And that's exactly what I did. And that is the only reason why I did not blow up this first account. Okay. And finally I found a footing. I found consistency. It took me another 6 to 12 months just to get to back break even, another 6 to 12 months just to get over PDT. And now we're talking, I have a $25,000 account. And at that point, I don't think I was even risking 1% at that point. I think it was something where I think I stayed at like 200. At this point, my account was starting to grow so fast for me being consistently profitable that my account was going up so fast that I emotionally couldn't keep up with the 1%. I had to drop it down to like 0.0, like 0.5%. So instead of risking 0.01, I was risking 0.05. I had a $25,000 account and I was only risking 0.5% at 125. And my account was still growing. I know it's not fun to hear. That's how I stayed alive, and that's how I had maybe a slow start. But obviously, if you see where I am now, I'm having quite the big increase. So it's slow to begin, but if you get the equation right and you get the formula and your strategy and edge correct, this ends up working out really, really well. And then once you have, let's say, forget 25,000, let's say you've got $250,000. Right now, you've got $250,000 in your account, and you've been profitable trading for 3, 4, 5 years, and you've taken thousands of trades, and you've seen hundreds of thousands of trades that show, oh, this breakout was really good because it had X, Y, and Z, or oh, this breakout wasn't as good because it was missing news, or this kind of volume, or this kind of characteristic that you've seen happen hundreds of times. Now you can start thinking about that. And again, these are still too big for me. If I was, let's use this example for $25,000 or $250,000. Yeah, maybe your average setup is you're going to risk 1,250. Maybe your A grade setup is going to be 1%. So you're going to risk, we'll get this whole math together, times 1% is 2,500, right? And maybe your A plus would be 2%, right? Let's do 2. And again, I'm just riffing off an example. You don't have to take this literally. You can find out what works best for you. But just as an example, this could be something, and then let's get rid of my early account numbers. Let's say a C grade, you're going to risk 0.025%, right? 0.25%, right? And then we do this times 0.25%. See how this this is almost perfectly exponential because it's perfectly fractions of each other. But see how that looks similar in terms of range to this? You have to get there though. Takes, I've been repeating myself like a broken record, but 3, 4, 5, maybe even 6 years in. And again, that's with all the things I just mentioned. That doesn't mean just because you've been trading for 6 years, you should do this. If you've been trading for 6 years and you're only up 50 grand in profits, that's a great start. That's good. You're still in the top 10% of making money versus losing, but you haven't gathered all of the criteria that I just mentioned of like having a big bankroll, actually, having maybe enough experience to really know, to truly know, because the last thing you want to do is do this too soon and give back all of your hard work, over the amount of years you've done it, right? Because it's a risk you take, like anything in trading. But that being said, and long story short, from the beginning of this video, I am in both camps. It just really, really, really depends on where you're at in your trading journey, and only you can know that for sure. So you have to be brutally honest with yourself, and fight the greed, fight the instant gratification of wanting to, double your account tomorrow. So you're going to risk super, super big now because you see me do it. But again, I didn't do that when I was where you were. Okay. So you have to have that discipline. You have to have that level of patience, and only people who have that are going to really be able to have those dividends get paid long-term and eventually get to here in year 7, 8, 9, 10, 11, 12, etc. So hopefully this video helped. Put in the comment section below how maybe you're going to approach it here. Again, what you're risking. As always, like and subscribe, and I will catch you guys in the next video. Thanks so much. Bye.